At the beginning of this year, I was very excited about US home builders. I even made a video where I explained that the price contraction on many of these builders was overdone. And then I put my money where my mouth was and I invested in one that I absolutely loved. Subsequently, the stock ran up 50% in 2021 and I was forced to sell. Well, that one may have gotten too expensive, but I think I found a smaller, less risky home builder that meets the criteria of what I'm looking for. And this one, ironically enough, has got the blessing of someone in the Buffett family. You're watching More Money? Let's get it. What's up guys, Tay here, and you're watching the #1 channel on YouTube for people that want to retire sooner. I truly believe that I provide some of the best due diligence on investment here on YouTube, so I'm glad that you've decided to join me. Now, most investors are very familiar with Warren Buffett. He's one of America's most iconic investors and CEO. But what if I told you that he wasn't the only Buffett that was a CEO of a growing conglomerate? That's right guys, Warren Buffett's great nephew, Alexander Buffett Rozek, is the CEO of a publicly traded company called Boston Omaha. And the apple doesn't fall far from the tree, as Boston Omaha is a company that is similar to Berkshire Hathaway in that they are both organized as an investment holding company. Now, what's interesting is that if you look through their website, they list some of the businesses in which they are invested in. What caught my eye was the only publicly traded company on the list, which was a very small home builder with national ambitions. The name, Dream Finders Homes. And I found this very interesting because all the OGs of this channel, you guys already know that I'm huge on home builders when most of the market isn't. And why is that? Well, the truth is that I'm big on spec home builders, which are builders that don't have too much inventory risk. That's my sweet spot. Also, from a secular demand perspective, I really think that there's a national shortage of homes due primarily to the increased demand outside of the big cities that the new post-COVID economy has created. Yes, working from home has changed the work culture, and this has helped us address one of the biggest problems facing the middle class today: housing affordability. In order to attract and retain the best talents, employers are now realizing that they have no choice but to allow younger workers and those with young families embrace a more hybrid work from home model, where some days are spent in the office and others are spent working from home. And I personally believe that if you have to drive into the office a couple of days a week, you'll be more willing to locate further out of the city to be able to purchase a larger and more affordable home. And the cat is already out of the bag. This is exactly what has been happening throughout 2021. Will it continue to happen once COVID is completely over? I absolutely believe so, and so does Jim Cramer. Other investors aren't so convinced just yet. I was curiously reading through the financials of DFH and noticed that they are so small that they may be overlooked by many investors. And the thing to know about small home builders is that you'll see in this video that they actually are less impacted by major real estate market declines than their larger counterparts. This was another reason why I was so interested in doing an analysis on this company. Now, you already know that on this channel, when we analyze companies, we use the Buffett 4-question model. So let's analyze DFM from that lens. Also, one super important investment that you could make is by smashing that like button. It really pays dividends in such that it helps YouTube know that the channel provides valuable content, and thus they'll share it with more viewers that really help it grow. So the first question is pretty simple. Is it a simple and easy to understand business model? Now, to be super blunt about it, it's just a home builder. And there are really only 3 types of home builders in the market. There's custom home builders, spec home builders, and tract home builders. The groupings, in my opinion, really just relate to inventory risk. Custom home builders work on a just-in-time model, so they don't buy up land or start building homes that are unsold. Whereas on the complete opposite end of the spectrum is the tract builders, which will start building up a whole neighborhood with the hopes to eventually sell all of the homes at some point in the process, meaning that they could have unsold inventory and thus they hold inventory risk. Why would they do that? Because they become the most competitive in terms of pricing for homes, because if you build a whole subdivision at one time, you're going to be able to build in economies of scale and thus be able to offer homes to customers at much cheaper than the custom and spec builders in the local area. Now, spec builders are a bit in the middle. They may own an inventory of land and not build anything on it until the house is sold, so they tend to take on less inventory risk, but their inventory risk is not as low as custom builders. DFH, I would say, sits on the custom home to spec home builder level, as they don't really sit on any land inventory just yet in their life cycle. As they become more and more of a national home builder, this will of course have to change if they want to remain competitive. DFH currently builds homes in the southern US in states including Florida, where they began in 2009, Texas, North Carolina, South Carolina, Georgia, Colorado, Virginia, and Maryland. Since they are early in their life cycles, DFH is able to use an investment-light lot acquisition strategy where they generally purchase land in a just-in-time manner with reduced upfront capital commitments. Very similar to the way that a custom home builder would operate, and very different from the way that a tract home builder would operate. Now, of course, as you'd imagine, this allows them to increase their inventory turnover rate because they effectively don't have any inventory. That lack of sunk funds into inventory makes them an asset-light home builder and allows them to grow much faster than their competition. And I don't think that's even the main benefit. I think the main benefit is that it also allows them to pivot quickly if the real estate market implodes, because they won't have to be stuck with higher priced unsold inventory like the larger home builders would be. But make no mistake, guys, this strategy is not special. They're able to do this right now because they're small. Eventually, this advantage will go away if they want to continue to grow, as they have to move more and more homes each quarter to move the needle significantly. And when you're selling higher and higher number of homes, efficiencies of scale matters because you don't want to be priced out by other more established home builders. So you'll have to invest in tracts of land and build hundreds of units at a time. Also note, guys, that this company is relatively new to the stock market. They IPO'd in January 25th of 2021 at $13 a share. So how would I evaluate the business model? And is this business model best of breed? Well, because they're small, they're able to get away with a spec business model. I wouldn't even say that they're the best of breed among spec builders because it's way too early to tell. They have largely been a beneficiary of a huge bull market for homes, so they've been in the right place at the right time. What I like here is that they are a strong, young management team and they're exploiting the right strategy, so I'm on board with them. If the market turns and home prices fall significantly, they'll be in the perfect position to capitalize because they won't have expensive unsold inventory, which the tract builders would be sitting on. If you recall from my LGI Homes video, I liked LGI Homes because they are tract builders, meaning that they don't really run the risk of holding on to too much unsold inventory in a downturn. It's a very safe business model if you feel as though we're on the cusp of the housing market declining. The downside of this business model, of course, I have to repeat myself, is that tract builders will always be able to build homes at a cheaper price as there are cost efficiency based on volume, which the spec builders cannot capitalize on. So there you have the business model. Let's move on to question number 2, which is, does this business have favorable long-term economics? Homes are an important asset, and from here you can see that since 1963, when data started being collected, new homes have averaged somewhere between 600 and 800,000 homes per year. And going back to this all-time chart, you can see how the pro-homeowner policies have considerably increased the number of new homes being sold in America up until the banking crisis in 2008, due primarily to the relaxed lending from US financial system. Getting a closer look at the 25-year chart, we can see, of course, that there was a recovery subsequent to 2009, spurred on by the low interest rate environment. Of course, guys, if interest rates tick upwards considerably, we can potentially see the reverse impact. But don't get too frightened, however, because higher interest rates, of course, can be offset by other tools that can aid the housing market, such as longer loan amortization terms or higher income tax credits on loan interest, to name a couple. Now, does DFH Homes have the ability to stand the test of time? I think the business as it is right now is inherently a low risk model which can absolutely stand the test of time. In this market, they have a very good strength, which is that they don't have inventory risk. I have to note, however, that they may have trouble the more they grow. To put it simply, they are unproven to play with the larger home builders, but they are young, smart, hungry, and are focusing on the right things. From a weakness perspective, because they are a small spec builder, and as explained earlier, the business model is such that they don't offer the best value for money, which could hurt them in the long run, especially when they try to become a national home builder. If you recall, this is the same issue that LGI Homes is expected to face as they try to become a Lennar or a DR Horton. So overall, DFM Homes does have a strong business model with insanely high returns on equity, but they are in an industry where there really is no way of differentiating yourself. No one really buys a home for its brand name. Let's keep that in mind when we incorporate this into our portfolios. This is not the type of business that's unrivaled like a Google, Amazon, Facebook, or Alibaba, nor does it have a recognizable brand name like any of the iconic brand names in the US. Now, the third question is it run by competent and willing management? The way I determine this is by analyzing their capital management, do an operational analysis, and then review the financial statements. So capital management is really what are they doing with their generated cash flow. Right now, you can see that they're doing what they should be doing with their generated cash flow, which is completely reinvesting it into the business to address the huge $1.6 billion in backlog of homes. The one item that I'm a little unsure about is that they have preferred mezzanine equity. I would like more information on this instrument. I want to know what amount of cash flows that the preferred mezzanine equity holders are entitled to, and if there are any conversion privileges. I don't think that this is a material item, as the value of it is only $6 million compared to $330 million of equity, so it's likely not an issue, but I'll look into it further as I'm not sure yet. Now, from an operational perspective, the question comes down to, are they meeting their growth and execution goals? From what we have seen so far this year, they're sticking to their guns with a forecasted 5,000 to 6,000 homes delivered in 2021. And as you can see from here, so far in 2021, they have delivered 2,000 homes. This is despite the slowdown incurred from the challenges that we've been seeing with lumber prices and transport prices. In order to get to that 5,000 to 6,000 homes forecast in 2021, they're gonna have to pick it up a bit, so we're gonna have to wait and see if they can execute. I have no reason to doubt them, and I am really rooting for them. Now, the third area when engaging management is, of course, a financial statement analysis. The first thing I like to ask is the balance sheet managed well? Now, because they have an asset-light business model, they don't have to rely on a heavy amount of non-construction financing. As such, they are aided in the risk department by having a very low debt to equity of 20%. When assessing the overall risk of business with home builders, this is a key area that I look to look at. Since it's very low with DFM Homes, I'm very comfortable. To put this into perspective, they expect to earn $158 million in 2021, and the full long-term debt amount is $30 million. So I have no concerns here at all. It's very hard to go bankrupt if you have no debt. Now, the fourth question is it selling at a favorable price, or is it trading at a significant margin of safety? So what you'll see from the model is that this is much simpler than any of the other models that I've given to you guys here on this channel. It's really just home closings times the average home sales price to get to the revenue amount, and then everything else just flows from there. As you can see from here that I've built in management's guidance in guiding towards 5,000 to 6,000 homes in 2021. As I mentioned earlier, they've only delivered approximately 2,000 in the first 6 months of the year, so they really have to pick it up at the back half of the year to meet this guidance level. I do believe that they can do it. So flowing that down, I'm forecasting an earnings per share of $1.74. Now here's where it gets interesting. The current share price reflects a multiple of 11.8 times earnings. With a large home builder like D.R. Hortons or Lennar, this could make some sense, but for a small builder with limited inventory risk and limited long-term debt risk like DFM Homes, I don't think it makes sense. Even if there's a big real estate crash tomorrow, I believe that DFH Homes is so small that they will close more number of homes in the following years. Remember, there's an average natural demand for new homes between 600 and 800,000 homes each year. So to say that they can't capture at least 1% of that is very difficult. Will it be harder to do that if there's a decline? Absolutely, but not impossible. And the upside, of course, is that if they capture just 2% of that market, we're looking at a stock price that doubles. So I don't think that the multiple should be 11.8 times 2021 earnings. I think it should be higher to more appropriately align with the growth trajectory of the company, and therefore I'm comfortable with a 15 times multiple for this company. Now, with that multiple, you can see that I'm arriving at a fair value of approximately $28 a share, and they're currently trading at approximately $21 a share, or 75% of that valuation. So would I buy the shares here at this price? It's very hard for me to say no, but it is a no for me for now, because I would like to buy the stocks that are closer to being priced at approximately 50% of their intrinsic value. But that's not the end of the story here, guys. Because this is a smaller security, it is exhibiting some really interesting cash secured put opportunities, which we'll be covering in part 2 of this 2-part series on DFM Homes. So if you don't want to miss out on that video, please consider subscribing to the channel and hitting that notification bell to be notified when I upload that video. I think there's some really awesome opportunities that I do want to explain to you. I really hope you gained some real value from this video, and I'll see you in part 2. See you guys.